Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So this week, it was all about the Fed and the return of volatility as the market experienced about a 4% drawdown off of its August peak. This came on the heels of a slew of Fed committee members that came out with various hawkish messages capped by Jerome Powell's speech in Jackson Hole, Wyoming on Friday. And finally, just a reminder in our tactical funds and portfolios, we still have maintained a defensive posture, something we have maintained for most of 2022. We do believe that risk remains elevated. So this is a chart of the S&P 500. You can see obviously the 24% drawdown, the official bear market that we have seen through June, and then the preceding rally of about 17% that peaked in August and ended late last week. And we've experienced about a 4 to 5% drawdown, depending on the broad market index that you're looking at. If we take a look at sort of the Fed actions this week, if we look back to the post-July median Fed, I think a lot of market participants came away from that. We saw this in a lot of the data that we observed here at Meeder, showing that people's expectations for the aggressiveness of rate hikes by the Fed had come down, right? People were not thinking they were going to be as aggressive. That was the interpretation. I believe that was part of the fuel that had led to a lot of the rally that we've seen over the past 6 weeks or so. Well, I think the Fed has started to try to combat that message. We saw Kashkari during the early part of this week put out a very hawkish message. We've seen various other Fed committee members, and I believe Powell's statements this morning, Friday, 10 a.m. in Jackson Hole, Wyoming, were some of the strongest that we've seen yet. Talked about the commitment to raising rates until they believe the inflation target down to 2%, right? We saw some signs of inflation slowing, but we're dramatically above that 2% now. He also talked about that we could see some economic damage done by increases in interest rates, but that combating inflation was a priority, right? So I think he came off very hawkish, and we've seen the market react with a bit of selling here to end the week because of that. Now, this is a chart we've shown in the past, but I think it's important to bring this back and looks at the data and says the Fed is not close to stopping rates, and you don't have to look further than this. You don't have to necessarily listen to the words that Powell is saying. If you look at every rate tightening cycle since 1974, the date that they stopped raising rates, the Fed funds rate was above 12-month inflation based off CPI every single time. And so in the green, you can see the Fed funds rate, and the blue is the CPI 12-month year-over-year growth rate. And every single time, the Fed funds rate, when they stop raising rates, is higher than CPI. Now look on the far right how different that is now with inflation at 8.5% and the Fed funds rate at 2.5%. I think this is at the heart of what Powell has mentioned today in his comments, even expanding on the sake that history has shown us that the willingness not to combat inflation does lead to consequences for the capital markets. Now, I want to briefly touch on our positioning within our tactical funds. If you look at the VIX index and the teal line on the chart and the MOVE index, that's the expected volatility of the bond market. It's kind of like the VIX of the bond market, the expected bond market risk. There's an interesting thing happening. After the big rally in equities, we saw the current VIX reading. This was as of Wednesday's close. The VIX reading of 23 was slightly below its 5-year average of 26. Compare that to the bond market risk, which is more than double its 5-year average, up to 133. All this to say, I think the bond market is pricing in a much more risk. And one of the things we've seen post-financial crisis is the Fed has played a much larger role, and we've seen bond market risk trickle over to the equity markets a lot more often during the past couple decades. And this is one of our big concerns here within our tactical portfolios. And before we wrap it up, I just want to remind everybody our tactical portfolios, Muirfield is our best representation from a mutual fund perspective. We offer these across obviously investment portfolios, risk-based and target withdrawal. this takes a look at our strategy, the defensive equity strategy, currently at 54%. We've been between 50 and 54% during the month of August, and we've been defensive for all of 2022, mainly because our quantitative models have talked about the above average valuations, inflation continuing to pressure those above average valuations, and the fact that the Fed is so behind the ball and it's going to take them a while to catch up, and potentially some of these credit spreads and credit risk metrics, yield curve notwithstanding, perhaps forecasting some longer term concern, and the fact that obviously trends and momentum have been choppy at best in 2022 with primarily downward momentum. All that to say, risk is still very elevated, and we still remain somewhat cautious for equity markets relative to how we entered 2021. 2022, we entered it very cautious, and we continue to remain cautious in these portfolios. And with that, I want to thank everyone for watching. Jackson Hole is once a year. It's put on by Kansas City. It's an economic symposium. It's actually the oldest central bank, all the way back to 1978 when the Kansas City Fed Committee started this. A couple facts about this for those of you that haven't been out there. Very beautiful area just south of the Yellowstone National Park. Yellowstone are our first national park in the world, actually, and actually predates the statehood of Wyoming before it became a state by about 18 years, I believe. And one other fact, Jackson Hole, maybe it makes sense that they're talking money there because it has the highest concentration of wealth per household than any other county in the nation. I think there's about 3 billionaires there, but the top 1% average net worth of about $20 million. So there's a lot of money out there in Wyoming, and they're trying to figure it out, obviously, with people from central banks around the world, academics and things like that for the symposium. A couple of fun facts about Jackson Hole, beautiful area, but a very wealthy area for people that often have second homes or nice estates out there in the mountains. With that, I want to thank everyone for watching, and I'll see you next time.